our plan is to return all the initial invested capital and still maintain the position in the fund by the end of year 4 or year 5.
Now let's shift to returns, guys. So Tom, what kind of returns, if an investor is considering investing with Haven Properties, might they be able to anticipate? Past performance not a guarantee of future results. Just kind of curious, how have you guys done so far, and what might somebody anticipate if they're going to invest with you?
Well, our Class A investor is a $250,000 minimum. We have a Class B that's also a $50,000 minimum. The common thing to both of them is an 8% preferred return. The Class A year 2 gets a 9%. The Class A on year 3 gives a 10% return. And that's based on the amount of capital invested. So that's the minimum return before we start sharing any of the profits that we make on a park. So it's investor focused. The investors earn their money first, and then we split very generously the rest of the potential operating profits with the investors. Overall, over a 5-year plan on our program, you can expect to see a 12 to 15% cash on cash return. And then once we get into disposition, if we choose to dispose of the properties, you're going to see a 22 to 27% return on your invested capital. And what's nice is if we return the capital, our plan is to return all the initial invested capital and still maintain the position in the fund by the end of year 4 or year 5. Once that's done, then we'll continue to run the fund for several more years till we maximize the value of the properties in our own. And then we'll liquidate the portfolio and return the capital.
Yep. Okay, great. Let me sure I got that.
Yep.
Make sure I got that, Brad. Maybe you can follow up with that. So if you're a Class A, that's $250,000, higher investment minimum, but you get 8% preferred year 1, 9% year 2, 10% year 3. Okay. And that's before there's any splits, is what I'm hearing. I'm hearing that right.
Yep.
Right.
And then over the life of that term, you might expect 12 to 15% on average cash on cash per year. If I'm hearing that right as well.
Yep. Per annum. Yep.
And then the last thing would be exit, like maybe 22 to 25 or 27% overall. And so let's break that into real numbers, Brad.
Yep.
I put $1 million in tomorrow, so I get Class A, right?
Yep.
So 8% is not, 80,000, right? In cash flow
Right.
year 1.
Right. Yep.
100,000 year 2,
Yep.
100,000 year 3. And
Right.
it's a cash out refi event or something of that nature in year 3 or 4 or 5.
Yep.
Then you would return, you've already paid that out, right? So
Yep.
the difference between, let's say 8, 9, and 10 up to, let's say 15 is the average.
Yep.
Extra payout. Is that a fair summary? Did I miss anything there?
No, you did not. And so basically at the end of year 3, which in our specific trajectory and what we're looking at with our fund, we're not striving for any type of leverage financing. It's not effective in today's market. With our current investor base, and we've explained to them, and in each one understands that we're coming in and we're purchasing these properties at investment nature, where a lot of people are still acquiring properties, and a lot of sellers are expecting these higher profits. We've completely abandoned them, and we've completely abandoned the agent side of it and the broker side of it. We're approaching sellers that are off-market mom and pops, as Tom had talked about earlier. I think at the end of the day, what we want to do is we want to return on $1 million investment, right? We want them to have $250,000 to $300,000 on their original investment, right? That's a 30%. Okay, so we want them to have at the end of the day that 30% and extend after return of capital that original $100,000 or $1 million that they put in. Right. So
what they would get at the end of the 5 years is they would see 2.6 million back.
Excellent. Right. Yeah. Put a million in, right? And let's say, what's that?
No, go ahead.
Let's say you put $1 million in today just to hear it. And let's imagine I took no distributions. I'm like, guys, don't give me any distributions. I get my $1 million back, plus what would be the total amount above and beyond that?
The $1 million on a 30% return?
Yeah.
Yeah, 350,000, right?
Okay.
So
on the million, you'd get 2.6 million back at the end of the 5 years.
Okay.
250%.
So $1 million plus $1.6 million, so 2.6.